Welcome to Successful Living. I'm your host, Rob Auclair, Certified Financial Planner at Balanced Wealth Management in East Greenwich, Rhode Island. As the new year approaches, lots of people want to change their habits, may want to go to the gym, may want to stop eating, may want to just change some things that didn't go so well in 2019. So we're going to talk about habit changing and not only starting one, but changing one. We're then going to be joined by our estate expert, Lynn Riley from Cameron and Mittleman. And Lynn will tell us how to actually protect our assets or our real estate from long-term care expenses. Then we're going to get into something that is dear to me, and it is about teaching kids about financial literacy. Many school systems do not have this integrated into their curriculum, and a lot of people have talked about doing that, but it lays on us, the parent, to then teach it. So we're going to tell you how you should do that at all age levels. And then finally we'll answer a question about educational savings. So let's start today with our word of the day. Our word of the day is habit, and habit is a settled or regular tendency or practice, especially one that is hard to give up. So every one of our days, all parts of our lives are made up of a series of habits. And those series of habits will create our mood, whether we are successful or not successful, our relationships. And I think many of us, we want to change our habits, and we have all the intentions in the world, but once we're changing them or starting a new one, we tend to lose ground. So what we want to do is try to explain to you how you might do that. And, you know, by the way, I am no expert at this. I'm trying every day and doing a lot of research to hopefully bring some good facts to you. So the first thing we need to take a look at is actually the science of a habit. So if we look at the science of a habit, there's first cues. And cues initiate our behaviors. It actually predicts it. So let's say you're at work, you hit a stumbling block at work. That's your cue. Then you have this craving. I want it to be better. You feel stuck, so you want to relieve this frustration or this stress. And then you get to the response, which is the actual habit. You pull out your phone, you check your social media, and then you get to your reward, which is that end goal. You satisfy your craving and you feel relieved. Checking social media becomes associated with feeling stalled at work. So this cycle that we look at is really an ongoing cycle that builds over time. And we start seeing that, okay, I stumble at work, I'm going to then go to social media, I'm going to feel good about myself, and that becomes a habit. And this, an example, is a bad habit. So how do we actually break out of that habit? So starting a new habit is always difficult. But what we want to do is we want to take a bad habit and actually change it to a good habit. So what can we do to do that? We can choose a substitute. So let's say it's the phone. Instead of picking up the phone, and this is just what I use, I have this little red book, and I say, okay, instead of picking up that phone, I'm going to jot down ideas that I want to do to help improve stuff. When we struggle eating healthy, maybe we pack some healthy alternatives. So that substitute is very good. Cutting out triggers. What we might want to do to cut out some triggers, let's go back to that phone example. And so when we cut out a trigger with a phone, a lot of times it's dinging. We can easily just shut it off, even though that's difficult. In a past episode, I talked about my email, and there's a great app. There's Boomerang and SaneBox, and it's a way to actually defer your emails for a certain period of time. And what that allows us to do is, you know, you don't have that dinging and trying to get there. Surround yourself, number 3, surround yourself with the right people. If you want to go to the gym now, having people in a similar environment is also going to be healthy to change that habit. Join groups. It's better to talk about it. All these habits are in our head. Talking about those habits really make it a reality. And finally, plan for failure. This is where we can be most successful. Even though we're going to fail, we're going to find ways that actually work. So don't get discouraged. Figure out a new way to do that. What separates top performers from everyone else is they get back on track really quickly. So 3 things we could quickly do to help us out to get a habit done. Schedule your day. Reduce your options. Don't have a million different options going there. And pause and breathe. When we come back, we'll be joined by Lynn Riley from Cameron and Mittleman. Stay right with us. Welcome back to Successful Living. Many of my clients actually tell me that they, for instance, for investments, that they want to get the best return, but they don't want to take any risk. When it comes to protecting their assets, they want to be able to protect the asset, but have full use of it and have no restrictions on it. And we're joined today by Lynn Riley, who's going to talk about the life estate deed and really what that is and some of the consequences that comes with it. And, you know, is it the appropriate thing to do to actually protect the home when it comes to long-term care costs? So first of all, welcome to the show. And
happy to be here.
And if you could tell us a little bit about the life estate deed, and then we'll get into some of those consequences of it.
Sure. So a life estate deed is a special deed, and it's been a planning technique for decades to help protect real estate from long-term care cost. It typically works like this. Dad transfers his primary residence to kids for, say, $1. And in the deed, Dad retains the right to live and use the property during his lifetime. Now, upon Dad's death, that life estate interest ceases to exist, and the kids then own the property free of any lien from long-term care costs. But there's consequences to that. So one of those...
Yeah, so let's talk, well, one quick question I had in there is, do you actually have to change the deed in that? Like, you physically change it?
Yep, you physically do a brand new deed.
Okay.
And in that deed, you transfer the property to the kids, and you retain that right. There's language in the deed to live and use the property.
Great, okay. All right, so yeah, let's take a look at some of those consequences and kind of walk through 5 facts to know about the life estate.
Sure. So one of the consequences is that transfer of the primary residence to the kids is a gift for Medicaid purposes. So the parent will not be eligible for Medicaid benefits to pay for his long-term nursing home cost for a period of 5 years. Once the 5 years has passed, the parent will be eligible for those Medicaid benefits to pay for nursing home costs to the extent he otherwise meets the criteria. He's sick enough and impoverished enough. Another consequence is that the state, if the parent receives Medicaid benefits during lifetime to pay for their nursing home care costs, the state puts a lien on that property. Now, the state won't make the parent or the kids sell the property while the parent is living, but there is a lien against that property. And typically what a state does is they collect the money they pay out on a Medicaid recipient's death. So when that recipient dies, there's probate assets, and the state can satisfy the money that they spent on a person for Medicaid benefits from those probate assets. A person's probate assets are assets in the person's individual name. Now, in our example, the parent that retained the life estate interest...
Is that in their name or is it in their kid's name?
Well, the parent has a life estate interest, but that life estate interest disappears on their death. And so the life estate never becomes part of the probate asset.
So they don't have to go through probate.
So they don't go through probate, and it doesn't become a probate asset. That life estate interest disappears at the parent's death, so the state has no way to satisfy that lien against the property. A big drawback is if the property is sold during the parent's lifetime, a portion of the sale proceeds is going to go back to the parent. And so the state can satisfy its lien out of those proceeds, okay? And if the parent didn't qualify for Medicaid benefits during lifetime, again, a portion of those sale proceeds, if the property was sold, would go back to the parent and still would have to be spent on their care. Okay, so I think that we have a screen regarding sort of how to figure out...
the calculation. I think that'd be helpful for our viewers. So if you could just walk us, through that.
Sure. So if you were to sell, say, Dad's residence, where Dad gave the residence to the kid for $400,000, and he retained the right to live in the property. In our example, Dad's 80 years old. So his life expectancy is about 12 years. So the right to live in the property is not going to be forever. It's only going to be for, like, say, a 12-year period. So based upon federal interest rates and his life expectancy, Dad's value if the property was sold, and the property is only $60,000.
All right, and in that calculation it says 15%, and just to clarify that, that's a factor of his age and his interest, and it's just a table that the IRS puts out there.
That's right. So it's based upon a life expectancy table, the Social Security tables, and federal interest rates that exist at the time of the sale of the property. So in our example, it happened to be 15%, approximately 15% of the value of the property. So if the property was sold, $60,000 would go back to Dad. If he had received Medicaid benefits, the state would get that $60,000. Otherwise, the money would just be spent down on Dad's care.
Okay. And in that example, let's say that the state only collected $50,000. That $10,000 becomes the dad's property, not the kid's property.
Well, if the state only expended $50,000 of benefits, then yes, they'd only get the $50,000, and the child would receive the balance of his proceeds. It's been beyond the 5-year period. They get to keep that. Okay.
Yeah.
So, but one of the other consequences to think about when you're doing the life estate deed is you are transferring an interest to the kids. So the kids become owners.
Right.
Okay, that means the kids' creditors can put liens against the property,
okay.
which can always be a problem. Now, typically, kids' creditors can't force the sale of the property during the parent's lifetime.
But they've got some hold or lien on it. At some point in time, they're going to get their money.
Right.
And then, you know, a lot of people always tell me, oh, my kids are fine. They're more successful than I was. It'll be fine. They don't have any liens because they're thinking of, okay, they owe credit card or they have this big, but they could get in a car accident and
accident, divorce, and you know, it's basically there's lots of things, and there'll be a lien against the property,
right.
which, you know, the sale could happen following mom and dad's death, a parent's death. But there has been at least one case recently where the parent was still alive and had a life estate interest, and the bankruptcy court forced the sale of the property, and the child who owned an interest in the property, his creditors got the bulk of the sale proceeds from the forced sale. The parent was left with no place to live and only a fraction of the sale proceeds because he was elderly and his interest in the property was really not of any significant value.
So that's an extremely negative thing, I would say, then, for this life estate deed, you know, in doing that.
It is, and that's why sometimes it's more appropriate to do an irrevocable Medicaid trust. So you have to go to an estate planning attorney and see, is it more appropriate for me to do a life estate deed, or would this irrevocable Medicaid trust be better? Because the irrevocable Medicaid trust has all the same tax benefits of a life estate deed. You avoid probate, you get an increase in basis upon the parent's death, you know, so there's all the tax benefits of a life estate deed with none of the drawbacks. If the property is sold during the parent's lifetime, the proceeds come back to the trust. That doesn't go to the parents to have to be spent down on the parent's care. Well,
so why wouldn't someone just do the irrevocable trust?
It's more expensive, to be honest with you.
That's really
it's
the
more
main
expensive,
factor.
right?
Okay.
I mean, a life estate deed will probably run you about $500 to $600.
Okay.
And then there's recording fees. So, you know, for less than $1,000, you can do the life estate.
And then a Medicare, I mean, just a ballpark
A Medicaid
idea.
trust will typically run you between $3,000 to $5,000.
All right,
so there's a price
it's 5
difference.
or 6 times the amount to
right.
do it. But you're doing and you've said this to me before. You take care of some of these issues up front, and you save the money on the back end when things, you know, down the road come.
That's right, because then you want to protect all of the proceeds from everybody's creditors, whether it's the child's creditors or the parent's creditors. It doesn't
Right.
really matter which set of creditors you got.
Yeah.
So another tax consequence that you have to think about when you do the life estate deed is if the property does have to be sold during lifetime,
Yeah.
you have capital gains taxes, right? So oftentimes, you know, the parent won't pay capital gains taxes because it's the sale of their primary residence.
Yep.
And they can exclude up to $250,000 of gain.
Okay.
But it's not the child's primary residence.
So there's no exclusion for the
So
child.
there's no exclusion for the
Okay.
child. And so, you know, and in our example, let's say that $400,000 property had an original cost basis, dad's original cost basis was $100,000.
Yeah.
We got $300,000 of gain. 15% is allocated to dad, but no capital gains taxes because this is his primary residence, right?
Yep.
But 85% is allocated to the child, who's going to pay $51,000 in capital gains taxes.
Wow.
Because his 85% of the gain is $255,000 multiplied by 20%, which is the state and federal combined capital gains taxes. So that could be a pretty hard pill to swallow to pay a $51,000 capital gains tax.
Do you find people doing the life estate deed on their own without an attorney, or
They-
just because it's that much cheaper and then they don't realize what they're missing by doing something a little different?
Well, a lot of times they do it with an attorney, but the attorney may not have a tax background, and so they may not realize all these adverse tax consequences. Again, if the property was held in the irrevocable Medicaid trust, instead of paying $51,000 in capital gains taxes, which was the example if it was not held in the irrevocable trust, there'd be 0 capital gains taxes.
Yeah.
Because all the tax would be attributable to the parent, and the parent gets to exclude the $250,000 gain.
Okay,
So-
and I think there's one more on your list.
And
Or
what's the
was that
last one
already-
on my list?
Capital gain, you already said, in the
Yeah,
sale
we
of a
talked
primary.
about it, right, the sale,
Oh, there's
so-
the step up of basis, we were saying.
There is the step up in basis. So one big advantage of the life estate deed, rather than gifting the property outright to kids, is that if a parent retained a life estate interest in the property, the full value of the property will be included in their estate for estate tax purposes upon their death. And the cost basis in the property will get a brand new cost basis equal to the fair market value at the date of death. And so if the kids sold it after dad died, they're not really going to have a capital gains taxes because their cost basis is equal to fair market value.
Okay. So that's a positive thing. It's better than doing nothing.
It's a positive thing. That's the same result if you had it in an irrevocable Medicaid trust.
Okay.
The disadvantage if dad transferred the property to the kids without retaining the life estate interest, he just gifted it to the kids to protect it and to get it out of his estate. Then if the kids did sell the property, they would have a capital gains tax on it because it would not get a step up in basis at dad's death. The kids retain dad's original cost basis, which in my example was the $100,000.
Yeah.
So as between an outright gift or a life estate deed, typically a life estate deed is oftentimes better. Between a life estate deed and an irrevocable trust, a lot of times the irrevocable trust is better.
Yeah. No, I can see where you're coming from, and I think I always tell this to my own clients is that you need to have someone that has this information, and we avoid all the things that seem super confusing to us. One of the things you do, and I think a lot of people in your field do, is they help clarify that when you sit in front of someone, you can do that. And having the initial conversation is so very important. And I've been lucky to have people like you that, you'll sit down with a client one time and you'll actually be able to put this in work and in their situation, and they get a good feel for it. And then they can make those decisions. So I think what we need to kind of tell our viewers is you shouldn't shy away from this because it sounds super confusing, but it's important to do stuff up front rather than react to it on the backside.
Right.
So one other quick question. We talk a lot about habits. When it comes to estate planning, tell me a little bit about someone that might have good habits and how it helps you do your job the right way.
Sure. Well, not leaving your estate plan to the last minute. When dad and mom is about to enter the nursing home, still see a practitioner who's knowledgeable in estate planning and Medicaid planning, but really don't wait to the last minute. If you wait to the last minute, you'll have very few options. You have a lot more options if you plan in advance.
Yeah. I think that goes for everything that's out there. So when we return, we're going to talk about talking to children about money and the best way we should do that. We'll be right back. Stay tuned. Welcome back to Successful Living. Have you thought, when is the right time to talk to my kids about money? How should I talk to kids about money? I don't do a good job on my own with money. How could I ever even teach them? Well, the fact is, you just need to teach them something. And there were a few statistics that when I was going through this that really stood out to me. 66% of parents that were polled for kids that were 18 years or older had regretted not talking enough about finances with their kids. 44% of Americans don't have a $400 emergency fund available, and 33% of Americans have yet to save for retirement. If you fall into any of those categories, I think they all lead to the idea of we need to pay more attention to finances, and we need to talk about them more. We don't necessarily have to sit our kids down for lesson after lesson after lesson, but it is super important to start talking to our kids. So when do we start talking? So break it down into 4 categories. The first, you got a child who's 5 and under. When do you talk to them? Talk to them about a piggy bank, what it means to save money, terminology, savings, spending, things that are on sale. Just make them familiar with it. Don't make it a job. Try to make it fun if you can. In the next age bracket, maybe 5 to 12 years old, you may start to have some chores for our kids. And so start to associate their chore with a dollar value and start implementing, hey, if you make $10, always save at least 10 or 20% and put that money aside. As they move to the next stage in their teenage years, now they may actually start getting a paycheck. Walk through that paycheck with that individual or with your child and describe that they hold taxes, they should also still be saving money. And then the 4th piece would be college. Put all that stuff together. Make sure you talk about credit cards. What happens is kids go to college, they come home with these new credit cards, and now they have debt and they have no idea what they even signed up for. It was just something where they had extra money. So here are some really good resources that I use, and clients ask me about this all the time. Number 1 is the Clear Jar. So resources for teaching our kids, the Clear Jar. Set up 2 large clear jars, put a cap on one, cut a hole in it, and tape the top so it can't be opened. And then take the other jar and just put it with the lid on it. What you want to write is spend and save. And so what you're going to do is every time that child gets money, for instance, $10, we're going to put $2 in the save, $8 in the spend, and now you can actually start talking about, hey, you want to buy something? You're going to spend some money here. Hey, you want to buy something long term? Let this accumulate, and after 3, 6, or 12 months, now see how much you have and see if they want to buy that bigger object that they might want to have. Number 2 resources, and I love this one, the Green Light resource. It's a card. If you go to greenlight.com, I use this with my son Andrew, and what Andrew has is a card that's not associated with his Social Security number. He can use it for debit, credit, or to get cash out. I link my account up with it. We list the chores that he's going to do and what days he's going to do it on and how much he's going to get for each chore. As he checks the box off on his app, on his iPad, and says, I did this, I make sure he did it, I approve it, $2 goes into his account, and now it starts building up. We have set that every dollar he gets, 20% goes to savings that he can't touch, 80% goes to spending, and then we cap off the different categories. If he goes to a restaurant or a place to eat, he can actually put a certain amount in there. If he's going to save money, another place. Very quickly, let's move on from that. That is a great one. That's my favorite. Stockpile is another one to talk about the investments. And then our 4th one, Practical Money Skills. This is a website within a website. And within that, what it does is it makes really, really fun games for our kids to play, and within it injects different lessons on money. So all 4 of those are great places in which we want to take a look at that. The goal is to not be scared about money, talk to your kids about money. When we return, we will talk about best ways to save for education. Stay tuned. Welcome back to Successful Living. We have another viewer question. Allison from North Smithfield writes, my twins are now starting school and we have yet to save for their education. What's the best investment vehicle to start saving for education? Well, Allison, it all depends once again, but let's quickly take a look. You can save in your own account, which will be taxed at your own rate, and you can use it for anything. You can put it in a UTMA or UGMA account, which is just a custodial account with your child's Social Security number on it. In most states, they can't touch it till they're 21. You can use it whenever you want. It is tax-free up to $1,000. And then a 529 plan, you can put in as much as you want, and it's tax-deferred. So take a look at those resources. We want to thank you guys very much for joining us today. We hope that as you approach the new year and work your way through the new year, that you will change some habits. You'll educate your children on financial literacy. Thank you again. We look forward to seeing you on the next episode of Successful Living. Have a great week.